Good evening, everyone. This is Dana from NexGen, and welcome to Me Inc. Tonight, we are going to be calculating our net worth, so get your paper and pencil ready, and we will be starting shortly. Next to budgeting, calculating your net worth is one of the most important things you can do for your financial wellness. Tonight, I would like to go over some definitions, some misconceptions. Then we're going to do some net worth calculations. And then we're going to go ahead and wrap it up. Let's go ahead and start with our gross income. So gross income is the sum of all wages, salaries, profits, interest payments, rents, and other forms of earnings. And this is before any deductions or taxes. Then we have the net income, and that refers to the amount an individual makes after deducting costs, allowances, and taxes, and it's sometimes referred to as our take-home pay. So this evening, I'm going to focus on a W-2 individual or a W-2 family, just to make things simple. And net worth is the value of all non-financial and financial assets owned by an individual, and we're talking the family unit as well, minus the value of all outstanding liabilities. So you may be saying, well, what's a non-financial asset? A non-financial asset is determined by the value of its physical traits and includes items such as real estate or even factory equipment. And that's for the business side. Intellectual property such as patents are also considered non-financial assets. Now, when we're talking about liquid assets, these are accounts or securities that can easily be converted to cash at little or no loss of it can be changed over to cash at little or no loss of the value. And these include cash, money in the bank, money market mutual funds, and even U.S. Treasury bills. In contrast, a liability is something that is owed to someone. So assets are what you own, liability is what you owe. And you will see in this illustration that your net worth is not dependent upon your ability to perform, but it is dependent on you. And I will tell you, there are some misconceptions out there. For example, your income and your net worth are the same thing. Well, I will tell you, based on the definition of net worth, income is not even part of the equation. And sometimes another misconception is sometimes people use their gross income when calculating their budget. For example, if a person, and I think we talked about it in our previous video, they made $290,000. That was their household income. When they do their budget, they're not going to use their gross income. They're going to use their take-home pay and or their after-tax pay when doing their budget. Another misconception is that you cannot have a negative net worth. You can make $1 million a year and still have a negative net worth. And you'll see it when we do the calculations because, again, your net worth and your income are two different things. Another misconception is that all net worth is liquid. And I talked about what the definition of liquid assets are. So when we go through the calculations or when I show you the different categories that makes up the net worth, you will see that some of these categories are not liquid. Another misconception is that net worth doesn't move. It's stagnant. Throughout your life, definitely throughout mine, my net worth has changed over time. So it's always important to know what your net worth is, whatever it may be, as soon as possible. And the last the last misconception I would like to share with you is that your net worth cannot increase in retirement. As I said before, your income may decrease, but the goal is to make sure that your net worth increases. So let's go ahead and take a look at the spreadsheet that I use to compute my net worth. This is an example of net worth assets. So what we have here is we have a category, and then we have, in this column, we have categories, and then in the next column, we have what we call items, and then you would plug in the value of those items. And if you do it every month or every quarter, then you'll know that some of these things would change. For example, on the properties, we have home, and if you have another home, if you have any retirement accounts, any savings that you have in there, and then under the investments, we have stocks, bonds, mutual funds, certificates of deposits, bullions, trust funds, if applicable. Then in the life insurance category, we have the health savings account, and we talked about that in a previous video. Then, of course, we have the face value of our life insurance policy. And then, of course, any other investments that you may have. Then in the other column, we have what they call cash or cash equivalents, and those are your checkings and savings accounts. And then the last category we have are properties, which are your cars, if you have another vehicle, any furnishings that you have in where you live, collectibles, jewelry, and any luxury goods such as furs or anything of that nature. So you would put all that information of what you own in this column. Okay, that is for your assets. Now let's take a look at your debts. What would go in the debts columns? So these are the categories we have. We have any mortgages you may have, any home equity loans, if you have a car loan, if you have any personal loans, credit cards, and of course, student loans, any loans that you have against any investments, such as if you have a loan against your certificate of deposit. And we talk about that in the family bank series. If you take out a loan against your life insurance, any installment loans, or any other debts, such as if you owe someone any money. So as you can see, these are blanked out right now. So that I didn't put any information in here. And that's usually how I started out. And so this person, let's say they graduated from high school. So they don't own anything and they don't owe anyone anything. So that's why you see the personal net worth as 0. And then, of course, the categories that I talked about, you have the life insurance here, your retirement savings, investments, any properties you may have, and also any cash or cash equivalents. This is kind of a snapshot of what you would see here. So as I said before, this is someone that is just starting out and they don't own anything and they don't owe anyone anything. So that's why the personal net worth was 0. But let's say we have someone that has finished school and they're just entering the job market, whether they finish school, whether it be trade school or just after high school or anything of that nature. So what we'll do is we'll take a look at what the net worth would be for someone that is just starting out. So again, we will start with the assets. So in the assets column, we have a home. Now this person just happens to be renting, so they don't own a home or any of these other things just yet. They haven't put anything in their health savings account. They have not purchased any life insurance. They didn't put any money in any certificates of deposit. The money that they make in their checking account pretty much goes out. But in this case, they just happen to save $1,000 in their savings account. And they did buy a vehicle. So this is the value of the vehicle when they looked it up in what they called the Kelley Blue Book. So this car, they just have one. It was $27,000. They don't have any furnishings or anything they wanted to list or any other vehicles, any collectibles or anything of that nature. So that's that for the assets. So let's go ahead and take a look at the debts. So you remember that they did have a car and the value was $27,000. However, their car loan is $35,000. They also have personal loans, which are $50,000. And of course, they have, in this case, they have student loan debt of $40,000. So this is someone that is just starting out. Okay, this is just an illustration. So if you take what they own and you subtract what they owe, then you should get their personal net worth. So we're going to scoot on over there. And it equates to, this is what we call a negative net worth. And the reason why it's a negative net worth is because their assets, which is $28,000, and what that's comprised of is their vehicle, which is $27,000, and the cash equivalent or their savings account, which is $1,000. So that is where the $28,000 comes from. However, their total debt equates to $125,000. So because their what they owe or their liabilities or their debt is higher or more than their assets, this is what we call a negative net worth. Okay, that was an example of a negative net worth. Now, what we're going to do is look at someone that is starting a family. So we start out with someone that was brand new to the workforce or brand new to they don't own anything and they don't owe anything. Then we just got finished doing someone who purchased things, but their assets are lower than their liability. So that's why you see a negative net worth. So let's take a look at someone who has a family. Okay, this is someone who has a family, and in this scenario, they have a home, and the value of that home is $410,000. They have a certificate of deposit, which is $150,000. And you notice that we don't see anything in the health savings account or the life um, insurance face value. Normally, if you had a health savings account or you had life insurance, you would put that information there. They do have $1,500 in the savings account. Their vehicles, they one is valued at 35,000, and the other one is valued at 20,000. They do have furnishings, and I'm assuming that's in their home for $50,000, and they have jewelry which is valued at 5,000. This is just an illustration. Let's take a look at their debts. Okay, so they have a mortgage that is $350,000. And out of the vehicles that they owe 20,000 on one of them. So and the other one is paid off. So that's why you see 20,000 on the value. They have personal loans for $5,000, and in this scenario, they have student loans that add up to $75,000. So this is a little bit more information. So you have a little bit more assets and you have a little bit more debt. So what we're going to do is go over to see how this all shakes out, if you will. So in this case, their assets are more than their debts. So their personal net worth is $221,500. So we have the property, which is 520,000. We have the investment, which is $150,000, and I believe that's from the CD. And the properties, I believe, are their vehicles and their house. And of course, the savings, which has $1,500 in there. So this one is a positive net worth. Although you remember that the house was $400,000, their personal net worth for this family is $221,000. So we've taken a look at, go ahead and close this one out. So we've taken a look at someone just starting out. They don't own anything and they don't owe anyone anything. Then you have someone who has accumulated more debt than they have assets. That's why you see a negative net worth. Now, you see, even though this family did make some purchases, their net worth is in the positive. So if they had paid off the house or they paid the house off sooner, as we did in the other scenario that we talked about, then you would see that their net worth would have increased. So that's why a lot of times people are trying to pay off their home, um, and they don't want to take the entire 30 years. number one, they will save on interest, and number two, it will increase their net worth. So let's go ahead and take a look at someone who basically is in the retirement category. Now, you remember me telling you that you can and should make have a higher net worth the older you get. You don't necessarily have to have a higher income because the income has nothing to do with the net worth. So let's take a look at someone that is in retirement. Okay, let's go ahead and take a look at their assets. Okay, they have a home, and that is the value of their home. They also have a second home, and that's the value of that home. This is their retirement accounts. They have stocks. They have all these investments. Okay, they have trust funds, and I believe that's for their children and grandchildren. Well, pretty much for their grandchildren. They did take advantage of the health savings account, and they have also taken advantage of having a life insurance policy, and that is the face value. They have other investments, and here are their cash equivalents. They have money in their checking, savings, and other. Now, personally, I would have preferred to have the higher amount in the savings account, but this is just a scenario, as I said before. They have multiple vehicles. This is the value of the furnishings. They do have collectibles, jewelry, and other luxury items. So that all goes into what we call the asset column. Let's take a look at their debt. Out of the homes that they own, they have $400,000 of debt. So that's what's remaining on their mortgage. They do have home equity loans, and they also have car loans, personal loans, credit cards, which I personally would like to see go down, but maybe they have a 0% interest rate or they're paying it down quickly. They do have student loans. They have loans against their investments, and they do have life insurance loans, other installment loans, and of course, they have other debt. So they have a lot of debt going on here. So let's see how it compares to their assets, which would be how we would get their personal net worth. Okay, so these people their personal net worth is $1.2 million. Now, in the asset column is almost $2 million. However, they do have a high debt of a little over $500,000. So their properties are $1.2 million, and that's their vehicles and their homes. And keeping in mind that their vehicles are depreciating. They have their investments, of course, the life insurance, retirement savings, and of course, their cash equivalents. So in this case, we have the personal net worth of $1.2 million. Now, if you remember, we did, I think it was last week, it was Wednesday, we did a book review on The Millionaire Next Door. So once you have calculated your net worth, then what you would do is you would multiply your age times your income divided by 10, and then that would give you where your net worth should be. I hope this exercise in calculating your net worth was helpful. Next week, we're planning to discuss net worth, to include this video in any questions we may get as a result of people reviewing the video. I would like to remind you that calculating your net worth has nothing to do with you as a person. Like budgeting, calculating your net worth helps you assess your financial wellness. That's why we discuss other wellness dimensions on this channel. Again, please put any questions you have in the comment section, and I will talk to you soon.
Make sure to like and subscribe and hit the notification bell so you can never miss another video.